Today we have for Group 1. My name is Moey Hui Xuan, the sheet number 286699. Binti Honey Sandra Berhad is an agri-business that sells pure fresh honey as its product named Sweet Honey. In 2024, the company sold 30,000 units of the product with a sale at 600,000 ringgit. The company hires sales agent to market the product, and currently the sales agent receives a total of 15% commission on each sales. Above image show the statements of profit or loss and other comprehensive income for the year end 31st December 2024. While we are as a group of business consultants want to help the business management to enhance understand the usefulness of accounting information and importance of applying CVP analysis for manager in decision making and provide suggestions for the company future planning. So for question 1, we will discuss more about the calculations of CVP analysis. The first calculation was sales price per unit. The formula is total sales divided by the unit sold. Given the sales is 600,000 ringgit, while the unit sold was at 30,000 unit, the sales price per unit is equal to 20 ringgit. The second calculation is the total variable cost. Given the variable cost of goods sold is at 300,000, whereas the sales agent will receive a 15% commissions on each sales at 90,000 ringgit, and add them up will get a total variable cost of 390,000 ringgit. The third calculation is variable cost per unit. The formula was taking the total variable cost I calculated just now, divided by the unit sold, and the variable cost per unit is equal to 13 ringgit. The fourth is to calculate the total fixed cost. The total fixed cost is equal to 126,000 ringgit, including the fixed cost of goods sold, fixed advertising expenses, rental expenses, administrative salary expenses, and the insurance expenses as well. The following calculation is contribution margin per unit. The formula for this calculation is take the sales price per unit, which is 20 ringgit, minus the variable cost per unit at 13 ringgit, and the contributions margin per unit is equal to 7 ringgit. While when we get the contribution margin per unit, we can calculate the contribution margin ratio, where the contribution margin per unit divided by the sales price. So it is equal to 0.35 or 35%. The last two calculations were regarding the break-even point. The formula for break-even point in unit was the total fixed cost 126,000 divided by the contribution margin per unit at 7 ringgit. So the break-even point was at 18,000 unit. Whereas for break-even point in Ringgit Malaysia was total fixed cost divided by the contribution margin ratio at 0.35, and the break-even point in Ringgit Malaysia was at 360,000. I will pass to the next presenter to continue the following questions. Thank you.
Good day, doctor. My name is Kuan Jun. My metric number is 284732. The question 2 is identify the units or product that need to be sold by the company in order to obtain a net income to sales ratio of 30% in 2025. Describe possible actions that should be taken by the company to achieve the target. Show the calculation. So, for my calculation, let X equal to units sold and Y equal to net income. Then we form a equation that is 20x minus 10x minus 60,000 minus 0.15 times 20x minus 50,000 minus 12,000 minus 30,000 and minus 9,000 equal to y. The second equation is the 0.3, that is 30% equal y divided by 20x. So y equal 6x. Use the equation to find the answer. 6x equal 20x minus 10x minus 60,000 minus 3x minus 50,000 minus 12,000 minus 30,000 minus 9,000. So x equal 126,000. So we find the x, our answer unit is 126,000 unit. Then the income is the y. Y equals 6 times 126,000, and the answer is 755,000. That's all for me. Thank you.
For question 3, if the company is not able to increase the number of units sold, it advises the company on the selling price that needs to be charged for the firm to earn operating income of 30% of sale. Briefly describe the possibility that the company can increase the amount of sale by simply increasing the selling price. So we need to use formula operating income, which is operating income equal to sale minus cost of goods sold minus operating expenses. Let's say X is the possibility that the company can increase the amount of sale. So 30% multiply 30,000x equal to 30,000 minus 36,000x minus 15% multiply 30,000x minus 15,000, and the final answer for X is 22 ringgit 73 cents.
With question 4, if the company plans to improve the quality of the product over the next year, suppose the improvement will increase the COGS variable cost to 55% per unit sales instead of at 50% at the current level. Fixed advertising expenses is expected to increase by 2,000 ringgit due to an advertising campaign planned to boost sales. It is expected that the product improvement combined with higher advertising expenses will increase sales by 200%. Discuss whether the company has the possibility to proceed with the plan. Justify your answer. So today I will start with the calculation. Today I present a quick analysis of our profit margin and explain why we are currently falling short of our target. Let's dive in. We start with the sale using 600,000 ringgit as the base and multiplying it by 200%. We achieve the total sale of 1,200,000 ringgit. This is the foundation of our analysis. Next, we calculate the cost. Variable costs. The cost of goods sold is 55% of sales, which is 660,000 ringgit. Adding another 15% in variable costs, we reach a total of 840,000 ringgit. Next is fixed cost. This includes expenses like rent, salaries and overhead. Adding them up to 17,000 ringgit, 12,000 ringgit, 30,000 ringgit and 9,000 ringgit, also 60,000 ringgit. We arrive at total fixed cost of 128,000 ringgit. Next, the profit and profit margin. Subtracting total cost from sales, we calculate the profit as 232,000. This gives us a profit margin of 19.33%, which is below the company's target of 30%. This gap highlights the need for improvements. To close this gap, I propose the following strategies. Like, first, increase the sales volume, expand market reach of improve customer retention. And second, reduce costs, negotiate supplier rates or optimize production processes. And the last one, reassess pricing, adjust pricing strategies to improve contribution margins while remaining competitive. And in conclusion, the company has a solid profit of 232,000, but is not meeting the 30% target by implementing these strategies. We can improve profitability. Thank you.
Hi, my name is Chun Hung. Now I will discuss about question 5. Based on the question 5, the company is faced with its sales agent requesting an increase in the sales commission rate to 20% for oncoming year. Company CEO decided to investigate the possibility of hiring its own sales staff to replace the network of sales agents. The company is expected to bear additional costs associated with this change. The company will have to hire 6 sales agents to cover the current market area, and the fixed salary cost of each employee will average get 500 per month. In addition to their fixed salary, the 6 sales agent will each earn commission at the rate of 5% of all sales. First, we need to find out the total sales commission for the 20%, total variable cost and total fixed cost for method 1. We take 600,000 multiplied by 20% and we will get the 120,000 for the total sales commission 20%. To find the total variable cost based on the statement profit or loss, we know that the variable cost COGS is 300,000 and plus with the sales commission 20%, which is 120,000. So we will get 420,000 for the total variable cost. For the total fixed cost, we will use fixed cost COGS plus fixed advertising expenses plus rental expenses plus administrative salary expenses plus insurance expenses. For all of these expenses and fixed COGS, we will get it from the statement of profit or loss of the Beast My Honey sendirian Berhad. Now we find out the sales commission 5% on all sales, fixed salary cost, total variable cost and total fixed cost for method 2. As we know, the total sales are 600,000, so we take it multiplied by 5% and we will get 30,000 for the total sales commission. For the fixed salary cost, according to the question 5, there are 6 employees and each employee will get 500 for the month. So we use 500 multiplied by 6% and 12 months. To getting total variable cost, we use variable COGS plus salary commission. So we will get the answer, the 330,000. Last, for the total fixed cost, we take fixed COGS plus fixed advertising expenses plus rental expenses plus administrative salary plus insurance expenses plus fixed salary cost. We will get the answer 162,000. After we calculate all of this data, we fill in this table to find out the contribution margin and net income. By using method 1, company will receive a positive net profit 54,000 with a lower contribution margin 6 ringgit per unit. By using method 2, company will receive a higher positive income or net profit 108,000 due to the higher fixed cost 162,000 and higher contribution margin 9 ringgit per unit. In conclusion, company should not disagree to the 20% increase in the sales commission rate for the current sales agent. Company should hire 6 sales agent and 5% commission on all sales. This is because to get more profitable than method 1.
Next, for question 6, the question is asking about the recommendations to implement in 2025 to boost the company performance and increase competitiveness in the market. While the goal of the company in 2025 is targeted to achieve a net income to sales ratio of 30%, however, for current year in 2024, the net income to sales ratio achieved at 14% only. Therefore, there is some recommendations for the company to improve it. The first one is optimize the cost management, especially focus on controlling the variable cost. This is because current variable cost per unit is quite high at around half of the sales. Therefore, the company is suggested to conduct negotiations via discount with the suppliers in order to lower the variable cost of goods sold. And at the same time, the company also must continuously monitor fixed costs to help minimize unnecessary expenditure and improve the cost efficiency. Besides, the company also should focus on product innovations and diversifications. So, for example, by introducing new honey-based products such as honey-infused beverage, skincare product, or health supplements to meet evolving consumer preference. So, we also suggest offering creative gift packaging for festive season to boost the company's seasonal sales. Diversifying the product line will not only reduce reliance on a single product only, but also to ensure steady demand and mitigate risks associated with the market fluctuations. The next recommendation is establishing strategic partnership. Company is suggested to collaborate with honey-based product manufacturers like bakery, beverage company, and skincare producers as well, which allow the company to supply honey in bulk at competitive rates. This ensures consistent demand for sweet honey while fostering long-term business relationship. As partnership with distribution can also support the company effort to penetrate new market and reach a wider audience. In short, collaborating with other businesses not only help to expand sales channel but also significantly increase the company revenue and the sales volume as well. In conclusion, accounting information and CVP analysis are essential tools for effective managerial decision making, while CVP analysis provide insight into the relationship between cost, sales volume, and profitability as well, allow data-driven strategy. By applying CVP analysis, Lim and Honey Sanjay Berhad can identify the opportunity to optimize the cost, improve the market reach, and diversify its product offerings. These insights support the company in aligning its actions with business objectives, driving sustainable growth and enhancing financial performance. That's all from our group. Thank you.